Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 75, we're going to look at a recent IRS private letter ruling which, by implication, created a conclusion that you could possibly draw that a withdrawal right in a trust, accompanied by nothing else but that withdrawal right, does not create a conduit trust. Now, this is kind of an extension of our previous discussion in episode 65, where we talked about the basics of trusts being named as beneficiaries of an IRA. So you may want to refer back to that episode before diving into this material. But for the time being, I want to also remind you that this presentation is not intended to substitute for legal or tax advice. So jumping into the meat and bones here, in episode 65, we examined, the basic issue with any situation where a trust is named as an IRA beneficiary, in that in order to get a stretching of RMDs beyond the 5-year payout for an entity, you must be able to identify the individual and not entity trust beneficiary who has the shortest life expectancy. And you can't have any entities as maybe even contingent remainder beneficiaries. Entities here would include maybe the decedent's estate or a charity or maybe even a non-look-through trust. So there's some colloquial terms given to different types of trust, being a conduit trust versus an accumulation trust. And the way the Treasury regulations approach this is that if all IRA distributions cannot be accumulated in the trust but must be distributed out to one or more beneficiaries in the same year, then you don't have to take into account the remainder beneficiaries because they're treated as mere potential successor beneficiaries. Thus, if they have a shorter life expectancy, you don't have to worry about their shorter life expectancy in calculating the RMD. However, if the IRA distributions can be accumulated in the trust, this creates principal of the trust, and really the standard of the regulation is that if any principal can be accumulated for remainder beneficiaries, and by implication that principal consists of IRA distributions, then all beneficiaries who can benefit from this accumulating principal are taken into account. And that could include every single potential beneficiary under the sun. So, in order to get an RMD stretch, it's usually better to be a conduit trust. Now, just today, the IRS issued Private Letter Ruling 2020-44001, and in this ruling there was a revocable trust by itself that was the named beneficiary of 6 IRAs. The decedent had not reached the required beginning date, so there was a full stretch available potentially, and the revocable trust was to distribute everything into a subtrust for the primary benefit of the spouse, and then the 2 children of the couple were the remainder beneficiaries. And in this case, the trustee could accumulate income, including IRA distributions, in the trust for the spouse's benefit, but the spouse had a demand right to withdraw trust assets. Now, the ruling only says that the withdrawal right applied to trust assets. It doesn't specify whether it was income or principal or both. It just says trust assets. Now, the outcome here was that the ruling concluded that all 3 beneficiaries, spouse and children, must be taken into account in determining the beneficiary with the shortest life expectancy. Now, that was indeed the spouse, and it wasn't really a big deal here, but interestingly enough, 1, the IRS didn't dig into any of the other remainder beneficiaries of the trust, and 2, the spouse's withdrawal right was not enough to prevent the IRS from considering their children as remainder beneficiaries in calculating the beneficiary with the shortest life expectancy. Now, the IRS merely included and cited the mere potential successor beneficiary regulation in looking at the analysis and potential legal citations, but they didn't actually directly cite this in any sort of factual conclusion. But the implication here is that the discretionary income distribution kept this from being a conduit trust, notwithstanding the fact that the spouse had a withdrawal right. Now, there's a lot of questions that serve as key takeaways out of this. What I found interesting is that the IRS didn't dig into the grantor trust rules, which could potentially have treated the spouse for income tax purposes as the owner of the IRA, for lack of a better term, under Code Section 678 by virtue of the withdrawal right. Now, if this had been a grantor trust with respect to the spouse, then you really wouldn't have needed to take into account the children, because the trust itself wouldn't be treated as the beneficiary in that case. Instead, it would be the spouse. So I found it weird that the IRS didn't really dig into that or cite that, and that may just be a taxpayer omission in the ruling request, because the ruling request was really just limited to Code Section 401A9. Now, another question is that, did the spouse's right to withdraw quote-unquote trust assets only apply to income and not corpus? Because technically the Code Section 678 withdrawal right has to apply to corpus in order to make this a grantor trust with respect to the spouse. So if that right only applied to income, arguably that could have kept it from being a 678 power. But regardless, that wasn't cited, so we don't dig into that. But even with that right to withdraw, my question is, why didn't the spouse simply withdraw the IRA and roll it over? We could have avoided some of that issue and the need for a ruling in that case. Now, if the spouse had been older than the decedent, that may not have been a benefit in this case. And if the withdrawal right only applied to income, then that wouldn't have been an available option anyway, as cited with the 678 power. But either way, what this ruling seems to imply is that you can't cut off the consideration of the life expectancy of the immediate remainder beneficiaries simply by giving one beneficiary a withdrawal right. And once again, the omission here, anecdotally, is that we only see that the withdrawal right applied to trust assets, and there is no breakdown of whether it applied to income or principal or both. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.